If you're a property owner or a real estate investor thinking about ways to defer the capital gains tax, you may have heard of a 1031 exchange. And this video will provide a complete overview, including what it is, how it works, and the benefits associated with using it, as well as the limitations. We'll also answer some frequently asked questions so that you can better understand if this type of transaction is right for you. Hi, I'm Ginger Chan, founder of WealthQuant. We work as financial tax strategists, and our focus is education, modeling, and strategic design, helping clients connect income planning, investment strategy, and tax planning into one cohesive, intelligent system instead of treating each decision in silos. Before we continue, a quick but important clarification. This session is for educational purposes only. Nothing discussed here is tax advice, legal advice, or investment advice. At WealthQuant, we don't provide tax or investment advice directly. We design strategies, perform advanced modeling and analysis, and coordinate with licensed CPAs and attorneys to verify, structure, and execute these strategies. Every example shared is illustrative, not a promise or guarantee. Real outcomes depend on your specific circumstances, eligibility, timing, structure, and the tax laws in effect at that time. So with that said, let's dive in. When you're preparing to sell an investment property, the biggest mistake you can make is waiting until after the sale to think about taxes. Once the transaction closes and the funds touch your account, the opportunity for a 1031 exchange is gone. A 1031 exchange is a provision in the U.S. tax code that allows real estate investors to defer capital gains taxes and depreciation recapture when they sell an investment or business use property and reinvest the proceeds into another qualifying like-kind investment property. Primary residences and flips do not qualify. This is for investment and business real estate only. So, for example, you can exchange a rental for another rental, an office building for a shopping center, but you cannot trade a personal residence for an investment property or vice versa. So instead of paying taxes when you sell, the money rolls forward into the next property, allowing your capital to keep working and compounding. And to qualify, the exchange must follow IRS rules. It doesn't eliminate taxes, it just defers it, often allowing investors to grow wealth more efficiently, restructure portfolios, or transition into a better property without taking the tax hit upfront. When you sell an asset for more than you paid for, that profit is called a capital gain. Imagine this. You bought a property for $400K, and a couple of years later, you sell it for $1 million. That $600K difference isn't just extra money. It's a taxable gain under U.S. law. If you're a U.S. citizen or resident, you are required to pay capital gains tax on profit like this. But here's where this strategy matters. How much you pay depends on how long you owned the asset. If you held it for 1 year or less, it's considered a short-term capital gain, and it's taxed at your ordinary income rate, the same rate as your salary or bonus. If you held it for more than a year, it becomes a long-term capital gain, and that typically qualifies for a lower, more favorable tax rate. So in simple English, short-term is equal to tax-like income, and long-term is equal to lower tax and better treatment. So how exactly does the 1031 exchange process work? Well, the first step is non-negotiable. You have to plan the sale upfront. You have to identify the property you want to sell, and you have to have a qualified intermediary, a QI, in place before your sale closes, not after. The QI is essential in this process. At closing, the sale proceeds cannot go to you. They must go directly to the QI. If the money hits your bank account, the exchange is disqualified. The IRS considers that constructive receipt, and taxes becomes due. Once the sale closes successfully through the QI, the clock then starts. You have 45 days from the close of the sale to identify potential replacement properties, and these needs to be in writing to the QI. And then you have 180 days to complete the purchase of the replacement property. These deadlines are strict. Missing them means losing the exchange. Also, you cannot trade a personal residence for an investment property or vice versa. For example, you can exchange a rental for another rental, an office building for a shopping center, but you cannot exchange an investment property for a personal residence. The replacement property must be held for investment or business purpose. Also, both properties, the one being sold and the one being bought, must be located in the US. Also, you should be aware of the related party rules. What does related party mean? The IRS has very specific rules about who counts as a related party. And under sections 267 and 707 of the tax code, related parties generally include close family members like spouses, parents, children, grandparents, grandchildren, brothers, and sisters, a grantor and a trust they created, corporations or partnerships under common control, and entities with more than 50% overlapping ownership. These exchanges come with special restrictions designed to prevent people from selling to themselves, shifting basis, or avoiding tax without a real economic change. And then you have the 2-year rule. If two related parties exchange properties directly, the IRS generally allows tax deferral only if both sides hold their new properties for at least 2 full years. If they sell too soon, the IRS can retroactively unwind the exchange and tax the gain. There are only a few narrow exceptions, things like death, involuntary conversion, or being able to prove that the deal wasn't designed to avoid taxes. If you're thinking about buying your replacement property from a related party, in most cases, that does not qualify, unless the related party is also doing a legitimate exchange. If the related party is simply receiving cash, the IRS will almost always deny deferral, even if you hold the property for 2 years, because they view it as a disguised cash out. That's being reinforced repeatedly in court cases and IRS rulings. What if you want to sell to a related party? Well, generally, it's a little more flexible. If the related party is the buyer and you're buying your replacement property from an unrelated seller, the IRS is typically more lenient. Why? Because you're staying invested in real estate and no one is cashing out, which is the whole purpose of Section 1031 in the first place. But again, the structure and the execution matter. So when can a related party exchange be denied? The IRS looks at one core question. Did this structure exist primarily to avoid taxes? If the answer even smells like yes, the exchange can be denied, especially if someone paid less tax than the taxpayer would have or if basis shifting occurred. On the other hand, exchanges have been approved when there was no tax abuse, no basis manipulation, and no one exiting real estate. So what should you do if you want to sell a property to a related party? Well, if you're considering selling a property to a related party and want to defer paying capital gains taxes on the sale, there are a few options. One option is to sell the property to an unrelated third party and use the proceeds from the sale to purchase a similar property through a 1031 exchange. This will allow you to defer paying capital gains taxes on the sale of the property as long as you follow all of the rules and regulations governing 1031 exchanges. Another option is to wait until the property is sold to an unrelated third party before engaging in a 1031 exchange. This will allow you to defer paying capital gains taxes on the sale of the property, but it may require you to hold on to the property for a longer period of time before being able to complete the 1031 exchange. So can you gift a 1031 exchange property to a family member? The answer is yes. It is possible to gift a 1031 exchange property to a family member. However, there are some strict requirements you should follow. the property must be transferred to a related party, which means a lineal descendant or ascendant of the transferor, or a spouse or a former spouse as a result of a divorce. Additionally, the property must be held for investment or used in a trade or business for the related party for at least 2 years from the date of the transfer. A well-designed 1031 exchange is one of the most refined ways to preserve capital and keep your money compounding instead of interrupting momentum to pay taxes. When executed correctly, it allows you to transition into a stronger investment property while deferring capital gains. But precision matters. Timing rules, identification deadlines, qualified intermediaries, and structure must align perfectly to protect the benefit. So if you're preparing to sell an investment property and want precision rather than guesswork, schedule a discovery call with us and see if this is the right strategy for you.